The last time the ECB made available 3-year loans, there was a massive take-up from Europe's banks, and it has been one of the driving forces behind the risk rally we have seen since. Ahead of the publication of the results of the uptake on Wednesday, I'm delighted to welcome Stephan Gallo from Schneider FX to talk about this key moment in the Eurozone story. Stephan, when we get the results, are you expecting this risk rally to continue?
The short answer to that question is yes, but depending on how much the take-up is. So how much the net liquidity or the net injection is as a result of the 3-year LTRO, which the data of which is released tomorrow. I think that will in part dictate the extent of the rally. I mean, based on the economic data that we've been seeing, based on some of the indicators we've been getting out of Asia as well, I think naturally the risk rally wants to head a little bit more to the upside. The risk rally wants to continue a bit. But it needs the constant prodding and help from the central banks. And so the bigger the take-up today and tomorrow from this 3-year LTRO, I think the more likely we are to see that risk rally continue in the very near term, at least until some kind of political situation in the Eurozone upsets this recent sort of downtrend we've seen in volatility and overall market sentiment. So I think it depends a lot on how much that take-up really is. The bigger the take-up, the more European financial institutions have to deploy in the risk trade. So there's a very strong correlation, I think, between those two things.
When do you expect market sentiment to shift? Is it just a case of wait and see, or do you think there are specific risks which we should be looking out for?
I think it's definitely going to involve Greece, so that means mid-March is definitely a period we want to be watching out for because of Greece's redemption. I mean, this 130 billion euro bailout now, which was just approved yesterday by the German parliament, the lower house anyway, is being dangled in front of Greece, but Greece has to implement adjustment programs in order to secure that funding. So there could be political disruptions there. And then social tensions in other weaker euro area member states need to be watched as well. I mean, there may be some strong reactions in the populace, in Portugal, because Greece is getting a lower rate of interest on its bailout as part of the restructuring and a part of this latest deal for Greece. So, and in combination with that, we still don't know how sluggish or not sluggish the recovery is going to be for the remainder of 2012 in the periphery of the Eurozone. So there are a lot of factors here, which the LTRO simply buys time against. It's sort of a hedge against those political risks. But over time, the effects of the LTRO fade. The effects of all QE fade. So there are political risks which need watching here, which even an aggressively large LTRO can't put off forever or can't, stave off for forever.
So let's talk currencies. How much higher do you expect euro dollar to go?
So I think 136, 137, maybe as high as 138.50, but I think that's really pushing it. I think we have to start looking, with Draghi at the helm of the ECB, with these LTROs, taking place, with the ECB's balance sheet really expanding now, and this new leadership style at the ECB, I think we have to start to look at 140 in euro dollar, at least for the near term, as the old 150 under Trichet. So it's a different ECB, it's in a different environment right now, and I think a weaker euro is desirable. On a big take-up in the LTRO, there may be an initial spike down in the euro, but I think the risk rally will continue if that take-up is quite large. So we could see those levels I just mentioned in euro dollar come into play. But this is for the very near term. I think as we get out into March and potentially further out, political disruptions could cause weakness in euro dollar.
I just want to quickly talk about the dollar-yen because I know you were surprised it weakened so much after staying in such a tight range for a long time. How much longer do you expect this pair to stay above 80?
It may stay up. It may hold up for a while longer. The data coming out of the U.S. We've got non-farm payrolls coming out soon. We're getting more data out of the U.S. For the month of February coming up as we head into March here. So if the data out of the U.S. remains strong, that yield differential, short-term yield differential between Japan and the United States could keep the pair supported, dollar-yen above 80, as you point out. But I think, my overall view, though, is that there are still structural forces which are forcing the yen higher. There's still a lot of demand for Japanese financial assets, yen-denominated assets, and a lot of these currencies, these floating currencies like the yen in Asia, are being used and traded as proxies for what probably is going to continue to be a stronger yuan. And while that currency is not fully fully convertible, there's not full convertibility under the capital account. I mean, there are going to be other proxies in demand in order to play that trade. In addition, I think we also have to watch for inflation risks in the region. You may see some of these Asian central banks reversing course on policy quite rapidly as we head into the middle of 2012 if Europe continues to muddle through and if these inflation pressures continue to build. So all those things are positive for currencies in that region, I think. So structurally, I still think there are a lot of forces pulling the yen higher. But as I say, if the U.S. data continue to not disappoint, we may continue to see dollar-yen remain above 80 in the very near term.
Okay, it's always great to speak to you, Stephen. The ECB will publish the uptake of the loans on Wednesday morning at 10:15 GMT, which is definitely a release worth keeping an eye on. But for now, goodbye.